Okay, great. Welcome, everybody. Thank you so much for joining us today on this special webinar titled What's Going On in the Economy? I'm Sean McKay with American IRA, and today we have the great privilege of hearing from an economist, Mr. Ron Thompson of Thompson Consulting and Analytics. Ron, thank you so much for joining us.
Thank you for having me.
Absolutely. I actually met Ron at a real estate conference, and him and I were both speaking. And when I heard that he was covering the topic of the economy and he was going to be digging into some of the analytics, if you will, I was very excited, and frankly, I was really impressed when I heard Ron speak on it. And he's certainly an incredibly knowledgeable individual. And so we're very lucky to have him share with us some of the data that he gets to pour over on a regular basis, and certainly much more value than I can ever bring to our clients and our potential clients in that arena. So very exciting. Now, certainly with that being said, as with any field, there's going to be certain areas where the individual feels as though that's their sphere of competence, and other areas where they feel as though it's best to leave that part of the conversation for other, in this case, economists and what have you. So certainly Ron is going to speak to the portions of the data that he's comfortable dissecting and sharing his insights on. And this is a great opportunity to make everyone aware we do have a questions box, so please type in your questions, and more than likely we'll be waiting till the end of the presentation to delve into those, but please feel free to type those in live time as you have things you'd like for presumably Ron to expand upon as it pertains to the data and his thoughts on the economy. So again, this is a joint presentation, so I'm Sean McKay with American IRA and Ron Thompson with Thompson Consulting and Analytics. So there's two sections to this presentation. First, we'll get into the American IRA, the self-directed concept, and that'll probably be about 15, maybe 20 minutes, and then we'll turn the floor over to Ron, the main event, if you will, so he can share his knowledge and make us all much more intelligent today. So this is exciting. So as we talk about retirement accounts, I think it's prudent for us to start with what we're familiar with and what's most typical for us to be investing in with our IRAs and 401ks. And in my mind, I think of it in two general categories: those investments that were kind of defensive, if you will, where we're looking to really just kind of preserve the capital that we have in our retirement accounts. And certainly for those that are elderly and they're not necessarily looking to grow their retirement accounts, there's a lot of great products out there, such as CDs, money markets, some sorts of treasury products, municipal bonds, things of that nature, where they're really just kind of looking to retain their purchasing power, if you will. And then the second category is what I consider more aggressive, more entrepreneurial sometimes investments, where there's the potential for some substantial growth with your capital if you make great decisions, but certainly there's also more risk associated with those investments. And for many individuals, that comes in the form of individual stocks or mutual funds, and in today's world, index funds, ETFs, products like that. And largely those can be really phenomenal products, and there's many individuals that have been very successful with those sorts of investments. Today, really, our goal is to just simply make you aware that there are other investment opportunities available to you with your IRAs and 401ks as well. So when we talk about a self-directed retirement account, which is our service at American IRA, I want us to keep in mind a few things. The first is that, as the name indicates, it is a self-directed account, meaning that you as the account holder are making the decisions for your portfolio. So this is a departure from this part of your portfolio being with a financial advisor, for example, who may be picking specific investment products for you. Now, I'm the first one to say advisors can be great resources for you. And keep in mind, as we talk about these self-directed accounts, this is not an all or nothing proposition. So you may have an account and decide to keep some significant portion of that account with your advisor, with your current banking relationships, but you may be moving over just simply a portion of your monies to a firm like American IRA so that you can invest in some different opportunities that your advisor does not have the capacity to assist you with. Which brings us to our next point, which is the types of investments that can be made. So the interesting thing about the self-directed concept is there is this additional world of available opportunities. We have clients that are investing directly into real estate deals. So their IRA or 401k can own 123 Apple Street in Charlotte, North Carolina. It can be a debt holder, either for businesses or put a lien on a property, for example, just as a bank would do for you many times if you're buying a primary residence, and also investing in privately held companies. We're seeing more and more startup companies and companies looking to go to the next level that are raising capital so that they can put that money into the business and create a more prolific business. And certainly precious metals, which is physical metals such as gold and silver. So this isn't a product, if you will, a financial services product. This is the physical bullion, the physical gold and silver that is actually stored at a depository that can be owned by your retirement account as well. Now at American IRA, we are considered the third-party administrator for your retirement account. And essentially what that means is that we do the record keeping for the IRA that we administer. And so we are what's considered a fully integrated financial services firm, meaning that American IRA is your administrator, and we're able to be in business because of our custodian, which is New Vision Trust Company. We're fully integrated, meaning that we have the same ownership for the administration company as we do for the custodian. Now, the benefit of that, and frankly, the brilliance of that, is that with an administrator, what you find is that you are at the mercy of your custodian. And in the self-directed world, because these are unique assets, there are times historically where administrators have been given notice by their custodians saying we're no longer interested in holding these assets. And so the brilliance of our principal Jim hit is to fully integrate so that we have the capacity to be in business regardless of the changing market cycles and what have you, and banking issues and the changing world, if you will, of banking and compliance and what have you. So this allows us to be fully integrated and to be able to continue to provide value to our clients for years and years to come. Now, we are in the self-directed space a really prolific resource for our clients. We have over 400 million in assets. And now if you compare that to the Bank of America's, the Wells Fargo's, that's frankly kind of a drop in the bucket. But we are a pretty substantial self-directed service provider. And the thing that really separates us from our competition is, in my mind, a few different aspects. The first is that our fees are very different than typical self-directed providers. We have a set annual fee for account balances over $7,500 of $285 a year, which is pretty extraordinary. Many times the cap on self-directed firms for their annual fee can be as much as $2,000 or $3,000 a year. So we are very cost effective. We're also very fortunate at our firm to have a high level of retention, especially amongst our senior staff. Many of us have been with the firm for 8, 9, 10 plus years. I've been very fortunate to be with this firm for over 10 years now. So a lot of continuity and a lot of expertise because we're also investors ourselves and we understand these assets. Now, when we talk about these self-directed accounts, please keep in mind that the retirement account you have will typically not change forms if you move a portion of that to us at American IRA. So for example, if you have a traditional IRA or sometimes called a rollover IRA, you would also be opening a traditional IRA with us. So you're just simply moving a portion of that traditional to a new traditional with us. We use the term self-directed. It's really a marketing term, but the retirement account itself is not changing forms. So The Roths go to Roths, traditionals go to traditionals. The same rules and regulations that apply to your account with Vanguard or Schwab, for example, apply to your account with us as well. The same ability to make contributions each year, the same ability to take distributions. Again, the only thing that's changing is a wider array of investment options that are available to you. Now, the one caveat to that is if you have an old employer-sponsored plan, such as a 401k, a 403b, a thrift savings plan, that will roll over typically into a traditional IRA with us, just as it would if you went from your old 401k to an account, again, with a Bank of America type firm as well. So the mechanics of the accounts are not changing forms. So interestingly enough, the way the IRS code is written is it tells us what we cannot invest in with our retirement accounts. And so there's not a list of things we can invest in, just what we cannot, which is essentially collectibles and life insurance policies. So as you look at these options, this is by no means a complete list, but certainly some of the more popular assets that our clients are investing in. So any type of physical real estate can be owned directly by your retirement account, whether it's raw land, condos, townhouses, single-family houses, commercial, industrial buildings, apartment complexes. Any type of physical real estate can be owned by that IRA or 401k. As we mentioned earlier, the ability to hold a debt instrument inside of your account is also possible as well. So depending upon the state that you live in, that might be a deed of trust or a mortgage that you're securing that money by. And again, you can secure money by a business and their equipment. So it doesn't necessarily have to be real estate related. So that's a UCC1 for those of you that are kind of in that world of creating debt instruments. That can be done inside of your retirement account as well. And again, precious metals, privately held companies is something we certainly see a lot of. And again, what we're seeing more and more of is individuals that are looking to get involved in larger deals, whether it's private equity deals, whether it's a group of investors coming together for a particular asset. And so the retirement account actually has the ability to be a member, to have equity in different types of companies such as LLCs and C Corps, etc. So a lot of flexibility with these retirement accounts. Now, historically, we've found that real estate is certainly a favorite amongst our clients. So the key is to make sure that you're investing in a piece of real estate with this account that is for investment purposes. So whether it's a piece of spec land that's just going to be sitting there, a house that maybe won't even be producing income, but you just think that it's going to go up in value over time. And certainly we see a lot of clients investing in rental properties, doing fix and flip deals. For those that are really savvy and work off-market real estate deals, essentially those not listed with realtors, there's the ability to wholesale and have options on properties. And really joint ventures is just the ability, again, for the retirement account to own a portion of an asset. So it's not the sole owner. It is involved in some sort of a partnership or multiple ownership type of scenario there. And private lending is essentially just another word for hard money lending or making an asset-based loan. So again, as long as it is an investment strategy, many times it can be utilized with these retirement accounts. And finally, as you're thinking about investments for your retirement account, I break it down into three general concepts of acquisition strategies. And most common is option one, where we see the retirement account, IRAs or 401ks, are the sole owner of the asset, and it is just simply paying cash for the asset. Ownership in the privately held company, the rental property, the precious metal, etc. The second option is for the IRA to do that joint venturing concept we spoke about, or partner with individuals, companies, or other retirement accounts. And many times those will be cash partnerships, but there are ways to utilize leverage, essentially, credit in those situations. The third option gets into that where the retirement account is going to be borrowing money from outside sources so that it can then acquire an asset. Now, typically that will be on real estate transactions where that asset will be a rental property, and presumably it will be throwing off income, producing income so that the IRA can make payments back to that debt holder, to that bank that has lent money to the retirement account itself. So a lot of ways you can structure these deals. But again, I really want to make sure we have plenty of time here for the main event, Mr. Ron Thompson. Ron, are you with us?
Yes, I am.
Okay, great. So I'm turning over the keyboard to you, and hopefully that works.
Okay, we will find out. Good afternoon or good morning, everyone. This is Ron Thompson from Thompson Consulting and Analytics. I would like to give you a little bit of background about myself. I started my career as a regional economist for an economic data and research firm, and then after serving a little bit of time there, after that, I went to work in the acquisitions department for an office and industrial REIT, where I helped out C-suite and also city-level asset managers figure out which product types work in a given market, which ones don't, and should we densify or should we prune, and that sort of thing. So I would say that my area of expertise is office, industrial, warehouse building, and also a little bit of retail. So my presentation, I will be, sort of giving some input on those property types. And also, again, I am an economist, which means that the sound of my voice has put more people to sleep than a hypnotist. So if you are awake at the end of this, then that means that you probably have insomnia. So with that, let's get to it. This is a graph of the national employment sector. Now, here's the thing. This graph, I was not able to get it updated to show the recent number. And this was a great graph. This was a great number. Showed that employment growth was at 304,000 jobs, and it also showed that the unemployment rate is really low. The latest number was 20,000 jobs, which fell well short of consensus expectations. Consensus expectations was 175,000 jobs. So some of the employment slides were not able to get updated. And to think of it as that's fine. We're going to talk about it. And you'll also understand sort of which data points maybe you should be concerned about and which ones are more there's not enough data to really get concerned about it. So, but this is what the national employment sector looked like before that last really horrific number. Now, with regards to 2018, 2018 was really a great year for economic growth. For employment growth. We looked at the economy producing 223,000 jobs per month. And if you look at it per sector, almost every sector added jobs, which is great. That's really the kind of growth that you want to see. The only sector that didn't was information services, and that was sort of a marginal loss. So again, 2018 we had widespread growth, and that's really the way you want to see an economy grow. Now, to give some perspective, this is year-over-year growth before, during, and then after the Great Recession. That gray bar that you see is the actual length, the official length of the Great Recession. And the thing that I would pay attention to is look at how long the duration was of negative employment growth, and look at how deep that trough is. And I think one of the things that my own personal view is the idea that recoveries take a lot longer. There's a lot more, a longer duration of negative employment growth before we get to the point where it becomes positive. And this actually goes back to the 2001 recession, and people tend to forget that. The 2001 recession had what was called the jobless recovery, where you had GDP growth and other economic variables that were increasing, but still job growth and hiring hadn't quite gotten traction yet. And I think that we need to get our mind around the fact that maybe that's just sort of how things go now when it comes to a recovery. This is something that, this graph here, it's something that I noticed, I'm not quite sure other people do or did. When you look at the Great Recession, full-time employment fell by a lot. That's the solid line. And part-time employment increased by a lot, and that's the the dotted line. And what that signified was a time where people that had been laid off, that had full-time jobs, could not find another full-time job. So they had to take part-time jobs, and sometimes really multiple part-time jobs in order to make ends meet. So for me, really, the recovery, the employment sector recovery, didn't really start until 2013. And that is the time, that green box, that's a go time, where full-time employment growth really started to ramp up, but also part-time employment growth started to actually decline. And what that signifies is a point in the economy where more people that wanted to work full-time were able to find full-time employment. And by the way, that dynamic is still in play, even in 2019. Even right now, there are more full-time jobs that are being filled in part-time. This graph shows corporate profits, and it's really important. Again, the gray bars represent the recession, but corporate profits, it's important because when corporations make money, then they spend money. They spend money on capital expenditures, but they also hire people. So, and if you look at the tail end of that graph, 2016 and beyond, corporate profits have been sort of edging upwards. So that's a good thing. And you want to see that. You want to see corporations making money because, again, it prompts them to hire more people. This graph right here shows real GDP. Real GDP chugs along. Chugs along is an actual economic term. And if you look, that Q4 number for GDP came in at 2.6%, which is a solid number. And we're actually going to look at the components of that number and sort of give you more color on what that number means. So I broke out GDP into three different components: the consumer-driven, business-driven, and government-driven. Consumer-driven GDP really comprises about 2/3 of all economic activity in this economy. So really, as the consumer goes, so does the economy. And if you look at it, one thing that I noticed is that consumer-driven growth it's not falling off a cliff, but you can see a trend of a downward trend. So as as a person just paying attention to that, I would sort of look at the trend, and maybe that gives me a little bit of something to pay attention to. Is that trend going to continue? Because if it does, we have to invest accordingly. And a large part of the consumer spending, it really has to do with consumer sentiment. Whether it's really consumer sentiment, investor sentiment, or business sentiment, all of these people and entities, they spend how they feel. So if they're confident about the prospect of the economy, well, then people spend more. And if people are less confident then about where the economy is going to be in 6 months, well, they don't spend as much. They save for a rainy day, and that causes a decrease in economic activity. What this here shows you is really that from the Great Recession up until now, consumer sentiment has been climbing. And even though at the end of that, you can see a little dip, that number actually ticked upwards in the last release. Now, I will be curious. The last release of consumer sentiment was before that horrible job number that I mentioned at the beginning of this presentation. So I will be interested to see what does consumer sentiment look like with that job number taken into account. Now, this graph here shows investor sentiment, and what this is it looks at individual investors and how do they feel about stock prices in the short term. And obviously, red shows that they're pessimistic or bearish with regard to their expectations. And if you look at how big that red bar is during the Great Recession, and in the most current bar on the slide, if you look really in February, bullish and neutral were pretty much the same. I mean, they were marginally, people were marginally more bullish than they were neutral. However, I did update this for for the first week of March. And from this data point here to the first week of March, the pessimistic or bearish statistic has gone from 20% up to 27%. And that, again, that job number, that weak job number, and probably with a couple other factors, has made investors feel a little bit less confident about about stock prices. One of the things that I like to look at as well, housing starts. If you look at 2006, we got nowhere near that number. I don't know how many of you were in the market at that time, but 2005, 2006, housing starts were just really robust. Well, if you look at during the Great Recession, they fell off a great deal, and we really haven't gotten back there. I mean, Q1 of 2018, we on an annual rate, we kind of reached that 20-year average, and then it started to wane some. But my thought, again, as an investor, when you look at multifamily, look at how small the multifamily starts were. And I remember back then that many investors were able to find distressed owners that had good properties, but for, again, the economy in the tank, and they were able to actually take advantage of that and expand their portfolios by acquiring properties from distressed owners, multifamily properties, and then taking advantage of when the market came back, because again, housing starts increased because demand increased. So the owners that had the capital, were able to take advantage of that dynamic. I really love this slide, and it shows retail sales, but it also shows e-commerce as a percentage of retail sales. And one of the things is that if you really look, first of all, e-commerce from 2000 up until now, the share of e-commerce of total retail sales has gone from really under 2% up to 10% now. But what I also want people to realize is that I think people have a misconception about how big e-commerce is. It's really only 10% of retail sales. So while it's a fast-growing segment, brick and mortar, and it's not as if it's 80% of retail sales. I mean, brick and mortar is still a large portion of it, and e-commerce is still a relatively small portion of it. And relatedly, if we look at e-commerce-related employment, which is really warehouse and transportation, from 2000 until now, that employment sector has increased by 26.4%. And that's versus 4.3% for retail. And again, I want to give a little bit of color about this. I'm really high I'm really bullish as an investor, or at least as an investment property type, on warehouse. I believe that the e-commerce trend is not going anywhere. But I also believe that the death knell of brick and mortar might be a little premature, because if you think about it, it has its challenges. Don't get me wrong, but when we think about where people want to live and where they want to work, we always hear about walkable. They want walkable neighborhoods to work in, walkable neighborhoods to live in, and I always think, well, where are they walking to? They're generally walking to some kind of retail. So as a niche product, property type, I believe that well-located neighborhood retail stores can actually give you a pretty good return. Again, if they're well-located, and if they're in a place where people want to walk and want to spend their money. Again, just my own thoughts on that. So again, like Rocky said, the world ain't all sunshine and rainbows. I will tell you, this slide made a lot more sense before that 20,000 job number that just came out. This was, again, the slide made a lot more sense when that job number wasn't there. But we're going to talk about now some of the challenges to the economy. And quite honestly, the biggest impediment, in my opinion, to employment growth has been the the lack of workers in the labor force. And if you know anything about the labor force participation rate, this is kind of another way to view it. If you look at that black bar, the black bar really indicates people that have left the labor force. And if you look, since before the Great Recession, during the Great Recession, and even afterwards, that number has increased and it has not come down. And when we think about the unemployment rate, people think, well, the labor market tight is at 4%, that's a good thing. Well, I'll explain why that number is a little bit deceptive. There's a reason why people are leaving the labor force. First of all, there's a mismatch between what employers want in terms of skills and what many people have to offer that are job seekers. So those people get discouraged and they leave the labor force. And by the way, if you are not actively looking for employment, you are not counted as unemployed. So that's why the unemployment rate is so low. One of the other factors with regards to the lack of people in the labor force is the opioid epidemic. And if you think about it, if you have a felony and or cannot pass a drug test, you're really not a viable job candidate. So what we're seeing is that that sector, they also left the labor force because, again, they cannot find jobs. And one of the interesting dynamics is that there are more employers now that are open to second chance opportunities, where they're willing to employ ex-felons that can pass a drug test, but that are also non-violent or don't have anything like that's a danger to the workplace going on. One of the things now, I would like to talk about economic challenges. People call them threats. I call them challenges. We're going to talk about income growth versus inflation, the trade war, the yield curve inversion, and also student loan debt. Now, if you look at this, really, the yellow bolded really shows that household median income is barely outpacing inflation. I mean, literally from 2000 until now, they're almost the same number. And while that's interesting, let's look at some of the other ones that are hospital services. Grows by 10.5% per year upon average. And when we think about student loan debt, and you wonder why is student loan debt out of control? Well, look at college tuition. College tuition is outpacing income by 3 times. Again, even books, educational books and supplies. Also, again, 8% per year upon average versus 2.7% per year income. So when we think about it, that's what it gives a lot of color into how money is being, how budgets are being affected by the increased price of certain goods and certain services. Now, with regard to the trade war, everyone talks about the trade war's effect on manufacturing. Well, if you look at employment, that the black dotted line shows when the trade war started, really manufacturing employment really wasn't affected that badly. And I'll also tell you that if you compared July 17 to January 18 compared to July 2018 and January 2019, well, the employment growth between those 2 years is pretty much the same. So, and with regard to that, I wasn't that concerned about the trade war with regards to employment because I didn't see anything negative happening from that data point. However, the PMI gave me pause. And what the PMI measures whether or not the manufacturing sector is expanding or is it contracting. A PMI above 50 means that manufacturing in this country is expanding. Below 50 means that the sector is contracting. And if you look, you can see that the PMI has been on a downward trend. It was at 60.8 in August, and it's been sort of on a downward trend ever since. So that gave me pause. Also, the recent employment number, the one that didn't get included in this presentation, which shows that manufacturing produced 4,000 jobs in this last release, and non-durable manufacturing actually lost 1,000 workers. So that would show you that non-durable manufacturing has actually been negative in 2 consecutive months. So again, it kind of gives me pause and kind of something I think we should pay attention to. Now this show, I actually created this on the Fed website and then borrowed it. This shows yield curves and recessions. And I don't know how many people have heard about the yield curve or yield curve inversion, but I'll give you like the quick little dealie on it. The yield curve is the 10-year interest rate minus the 2-year interest rate. And generally, when you subtract those two, that number is positive. When you subtract it and it becomes negative, well, that's called yield curve inversion. And what economists have noticed is that when you have an extended amount of yield curve inversion, that is generally a harbinger of an upcoming recession, generally within 12 to 24 months. You see that actually the yield curve going negative has predicted the last 3 recessions here. I believe it's predicted the last 7 recessions in general. And about a month ago, people had said that the yield curve had inverted. Well, according to the Fed and according to this chart, it hasn't inverted yet, but we're getting dangerously close. So that would be something that, again, I would pay attention to. And we're also going to look at student loan debt. And I don't believe that we talk about student loan debt, but I don't know if people understand how student loan debt is actually crushing borrowers. In 2003, student loan debt was $250 billion. If you look at 2018, student loan debt is now about $1.5 trillion. And to put that in perspective, in 2003, quarter one, student loan debt was 3% of total debt. In 2018, quarter four, student loan debt is now 11% of all debt. And again, when we go back to the inflation that is related to education and tuition and books, it makes sense. It makes sense why student loan debt is an increasing amount of overall debt. So you get to the end of this, if you're still awake, and you're asking, well, Ron, what does all this mean? What do you think about the economy in 2019? What are your expectations? Well, we feel that employment growth, which was, again, 223,000 jobs per month in 2018, is going to moderate to about 170 a month in 2019. We expect solid but not outstanding real GDP growth at 2.5%. And again, the labor shortage that we talked about is not going anywhere. And we expect the unemployment rate to average out to be about 3.9% for the year. And with that, I will turn it back over to Sean.
Perfect. Well, that was fantastic. I appreciate that. That was a nice deep dive there. Thank you so much, Ron. So what I'll do is I'll take the controls back here. And again, for those that are non-current clients, as we kind of shift back briefly to these retirement accounts, what I'll just simply ask you to keep in mind as you're looking at potential investments and you're analyzing the economy is that before you could take advantage of any investment opportunities, please make sure that you open and fund your retirement account with the appropriate financial services firm. Then go and identify the asset, whether it's an industrial building, whether it's private stock, precious metals, etc. And we're here to assist you with the documentation for that. And then ultimately, the net result is that your retirement account owns the property, the asset, whatever the case may be. So again, Ron, that was fantastic information. Again, for those listening live, we do have a questions box. So please feel free to type in any questions you have regarding the self-directed concept, but presumably most certainly what Ron was good enough to share with us today. So I'll leave that up there. So again, contact information for us at American IRA. I'm Sean McKay. My email is sean at VPofAmericanIRA.com. Our Charlotte office, where I'm located today, that number is 704-633-8155. We also have a full staff at our headquarters in Asheville, North Carolina, and that number is 866-7500-IRA, which is 472. And Ron, again with Ron Thompson, Thompson Consulting and Analytics. Again, Ron is the principal of the firm, and his email is rthompson@tcaanalytics.com. And so, Ron, you had spoken about the student debt concept and how that seems to be becoming a bigger and bigger issue. Certainly that's something that that is discussed on different blogs and TV programs and things like that. Do you have any thoughts on as that grows, how does that manifest itself in terms of this issue? Could you speak to that at all?
Absolutely. One of the things that we have to realize is that there's a multiplier effect. So money that is being sort of absorbed by student loan debt is really not circulating into the economy in terms of spending. One of the other things is that if we believe that secondary education is the way to go in terms of, again, creating viable workers that are well educated, the student loan debt or the fear of it actually pushes people out of those job sectors that A, are higher paying, and then B, that require that sort of education. I believe that from an economic standpoint, from the economic impact standpoint, I don't know that anyone's ever looked at it. But if you think about it, if student loan debt is 1.55 trillion, then there's probably and let's say I don't know how much of that is going to be defaulted upon, or do they extend it out to the point they don't have to default on it, but it disproportionately weighs upon spending. And so I believe that from an economic standpoint, if let's say the impact was 500 billion, then the total impact of that would be more than that. It would probably be 2 to 3 times that in terms of what the economic benefit to the economy could be if that wasn't a factor.
Perfect. Great. And so a follow-up question to that on the questions box was, do you see that causing a real estate collapse? Essentially, I guess the thought being that with the challenge with the debt load that these students coming out of college are having to deal with, making it tougher to buy houses, and if you could speak to that at all, if you have any ways of thinking about that macro or forecasting.
Absolutely. Well, one of the things that I do is outside of sort of economic analysis, that you really pay attention. And one of the things during the Great Recession was, and again, I just believe that what you noticed was that there were home buying fell, but as well as multifamily was a little bit challenged. Multifamily bounced back quicker than single family with regards to just to sort of investing. But there were a lot of millennials that were back home and that were kind of leery about getting apartments because of, again, the way that the job market was. So I would say that with the student loan debt, it's going to force people to have roommates and to cohabitate more. So from a multifamily standpoint, you would probably see more people per apartment. So you would see people densifying within an apartment. So in terms of starts and in terms of builds, you would see somewhat less demand simply because more people are living in the same space. In terms of home buying, with student loan debt increasing, people would tend to more than likely wait to buy a home because they need to get in a better financial situation. And also, of course, with the idea that student loan debt cannot be eradicated with bankruptcy. So so the student loan debt isn't going anywhere. But I do believe that it will cause a densification in multifamily with regard to people disproportionately living together, and then in single family, sort of the people waiting to actually purchase homes.
Interesting. Okay, great. There was a question about Brexit and whether you thought that would have a material effect on the U.S. economy at any point.
And it's interesting because, well, first it's to me, first of all, it's crazy that that's still going on over there. Let's just say. But but what you look at, and I believe that we need to consider the fact that whether things happen in this country or not, they're interrelated. So I believe that first of all, there's chaos over there. They really have no idea about what's happening and what they want, because they should not have voted for it in the first place if they didn't know sort of what it was going to do. But from an economic standpoint, discord tends to, whether it's political or otherwise, tends to sort of dampen economic activity. So from a trade balance standpoint, I could see a situation where that might hurt them actually importing more goods. Now, I don't know offhand how much we actually export to the UK, mm-hmm. but that would probably be where you would see that impact would be in the sort of the import export of goods and services.
Perfect. And bear with me here, Ron. Just one last question. This is a little lengthier. I'll just read this. What do you think regarding the vast amount of corporate debt, especially that created by corporate borrowing money at extremely low rates for stock buybacks? If interest rates go up and even a little bit, many corporations rated as triple B could trip over the junk status because they won't be able to refinance their debt at favorable rates. Any thoughts on that kind of general aspect of the highly levered corporate world, and obviously having had the benefit over the last, frankly, but even longer 10 years of low interest rates, on how that could play out?
Absolutely. I think that the person who wrote the question brings up a valid point, and I believe that if they are not able to get a refinance at a good rate now, then yes, their balance sheets are going to take a hit with regard to a credit rating, and that was one of the. And I'll give you a little bit of color. Back in 2008, I was working again. Like I said, I was working for a REIT, and when we saw that the economy was going south, we were able to actually leverage a debt facility, and we were able to refinance debt at a better rate. We also were able to sort of we also did a stock issue, so we were able to raise capital and pay down some of the debt that was at a higher rate, and actually improve our balance sheet. One of the things, whether it's a big corporation or even a small investor, is that if you're going to do some investing, you need capital. Take advantage of when the capital is cheap, because my viewpoint is that in another year, if these debt maturities come up, a lot of those companies that are not able to refinance are going to actually take a pretty significant hit with regards to credit rating, because if, interest rates have been kept artificially low, and that can't go on forever. So that's just sort of my sort of take on it is that, yeah, I believe that the person that asked the question is spot on. That's going to be an issue.
Perfect. Yeah, that was a great question. And just last one for you, Ron. Again, appreciate everything. Since we just passed the 10-year mark of the stock market bull run, do you think there will simply be an overreaction to a world event that sends the economy into a recession? Either maybe the economy or the markets. Do you think it just becomes a flimsier market, if you will, as this bull run continues? Do you have any macro thoughts? Again, this may or may not be something you're comfortable with.
No, absolutely. Well, allow me to say this, and because for the last, I would say, several months, people have been saying, well, we're in the ninth inning of this recovery and batten down the hatches. And quite honestly, there's no reason to really think that outside of the fact that people just get antsy. It's been growth for a long time, and people just get antsy and they wait for the shoe to drop that doesn't necessarily have to drop. Even with, and allow me to say this, even with the bad employment number that just came out, I've done this long enough where I don't get rattled by a single bad data point. Now, if there are several bad data points, or even a single one that's tethered to other ones that were also bad, then okay, I start to get a little shaky about it. But if you were to ask me where we are in this cycle, I would say yes, we're in the mature portion of this economic cycle. I believe probably closer to the eighth inning than closer to the eighth inning than I would say the ninth. But when we talk about it, and again with sentiment and expectations, that really does drive a lot of economic activity. And I think that there's a heightened fear that there's going to be a recession. And I think that people are sort of waiting for it to happen, and it may actually be a self-fulfilling prophecy. When we do our forecast, and you saw the 170,000 jobs a month, the idea was that the first half of this year, in terms of employment growth, would be better than the second half. Just the way that we were looking at this, when we didn't say that we didn't think there was going to be recession in 2019. That being said, with regard to the stock market, I can't, and I would tell you this way, I can't make head nor tails of it, because there would be what seemed to be a really stiff correction, and then the next day it's up by another 500 points, and it just keeps on going. So I think that people could overreact. I think that is sort of the mentality at this time within economic recovery, but I don't know that it would happen. I don't know that the overreaction is going to happen this year. I think the stock market growth is going to slow, but I don't know that there'll be just a huge, a huge overcorrection. Call it within the next 6 months.
Okay, terrific. Well, this was fantastic, Ron. I really appreciate your expertise and being able to add a ton of value to the conversation. And, certainly I think we all appreciate that there's nobody that has the crystal ball and can definitively time markets or speak to any sort of softening, recessions, and what have you. But I think it gives us some great tools as we're moving forward in our lives and in our investing, and, perhaps plans for our careers to just get that specific information that's data driven from you. So, Ron, really appreciate your time today.
Thank you very much for having me.
Absolutely. And thank you all so much, those listening to this live, great questions, and those listening to the recording. Again, the contact information is up here to speak to the appropriate resources for your questions and your comments. Thank you all so much, and hopefully we will see you at another webinar or live event here soon. So, Ron, any final thought?
Just one. At TCA, we actually do produce a free monthly economic snapshot. We do that for the U.S., and we also do it for the states and certain regions. If you would like to be added to the mailing list, feel free to contact me. You can use my email address right there, which is rthompson@tcaanalytics.com, and I can add you to the mailing list, and we do all the work for you. All you have to do is read it and helps you understand things.
Doesn't get better than that. So that's a great tool. Thank you for offering that. And so fantastic. Well, thank you all so much. And again, hopefully we'll see you at another event soon. Thanks again, Ron.
All right. Thank you.
Bye now.